Unfortunately, the majority of investors lose money when the stock market crashes. Instead of losing money, you can really gain a lot of money if you have the proper mindset and invest in the right way. Hello and welcome back to Wealth-ology. For today's video, we will be going to talk about how to make millions from huge crash ahead. Let's get started.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
And as you are all aware, we are currently in the midst of a stock market crisis, with stocks down well over 20% and panicked at an all-time high. The question is, what do we do now? Number 1, over the long term, stocks will go up. The first is that stocks will rise over time because stocks are part of a business, and businesses' main purpose is to generate money at the end of the day. Do you think businesses will make more or less money in 3, 5, or 10 years? Of course, they'll produce more. Corporate earnings grow at an annual pace of roughly 8%, according to Peter Lynch. This implies they double every 9 years, owing to compounding. As a result, the stock market should quadruple every 9 years. So, in order to grasp the second principle, you must first understand the first basis. Number 2, buy stocks when they're low, in and after a crash. The second idea is to buy equities when they are at their lowest point. As the collision reaches its peak, things are going to get better in a long run. So, when do you intend to purchase it? When is the optimal moment to do something? Of course, at the very bottom. For us investors, a market meltdown is beneficial. I love volatility, as Peter Lynch says. Number 3. Buy good quality businesses. Purchase high-quality enterprises. Consider some of the examples he gave in the video. Taco Bell had no debt and no restaurant closures back then. It was also a thriving business. Lynch expected it to rise in a long run. He also highlighted Coca-Cola. Because it was such a high-quality enterprise, it was unavoidable that it would rise in the long run.
I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range, or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logics, I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires.
Over the short run, no one can predict what will happen in the stock markets. It is simply not conceivable. If they're lucky, they might get it right once or twice, but they can't do it on a regular basis. Otherwise, they'd be filthy rich. However, we do know that the stock market will rise in a long run. That is why it is critical that we begin investing for the long term while stocks are low and cheap, as they are right now. However, the Lynch points out these must be in companies that we are familiar with. We must devote time and effort to learning the balance sheet, income statements, profitability, surprise comparisons, and other fundamentals. If we do not do so, we will most likely come out at the bottom. Peter Lynch also advised that you should be knowledgeable about history. So if we look back about 75 years, we can have a fair idea of how the market operates. One thing we should take away from this graph is pretty much what we've been saying throughout the video. The optimum time to invest in the stock markets is when the prices are low, at the points, the highs, and in the midst of crashes. Not always, especially when everything is going great, because items are more expensive and, to be honest, it's rather basic. So, which suggestion do you believe will help you better comprehend how to make millions from a huge crash? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to our channel for more videos like this. Thank you for stopping by to watch. See you on our next video.